Live from Singapore, welcome to our new show, diving deeper into the stories that matter with crucial context and sharp analysis. This is Insight with me, Haslinda Amin. Asian equities having a rough day as investors are shaken by higher bond yields and the stronger dollar, all on the back of cooling expectations for Fed rate cuts. In a moment, we speak to famed economist and strategist Ed Yardeni, who recently updated his Fed predictions to none and done. He also thinks the U.S. presidential election will be a really close one. Meanwhile, India says it's patched up differences over the border with China, paving the way for a possible Modi-Xi meeting at the BRICS summit. And the U.S. Under-Secretary of State for Energy Resources shares how Washington is viewing that thaw in India-China relations as both countries become the biggest buyers of Russian oil and gas. Well, Asian markets are picking up on the overnight sell-off in U.S. assets, with Treasury yields jumping and stocks cooling off. On bets the Fed will slow down the pace of its rate cuts. Kansas City Fed President Geoffrey Pyatt says he favors a slower pace of rate reductions, and Neil Kashkari of Minneapolis also sees smaller cuts in the future. Well, with me is Bloomberg MLive Executive Editor Mark Cudmore, and also joining us is a very special guest. We have Ed Yardeni, President of Yardeni Research. Ed, good to have you with us. We appreciate you keeping up a late night, 11 p.m. in New York. Let's start with that sell-off in the bond market. We saw 10-year yields rising 11 basis points over the course of a month. We've seen it rise about 40, 50 basis points. How much deeper do you think this sell-off will be?
Yeah, well, I'm really not surprised by it. I was thinking that there was really no particular reason why the Fed had to rush to lower interest rates at the September 18th meeting, and I expected a quarter point. Instead, they did a 50 basis points. And as you recall, back at the Jackson Hole, Wyoming conference on August 3rd, Jerome Powell did a pivot and came out extremely dovish. And again, I couldn't really understand that. And I did think that with the Fed dropping 50 basis points, I concluded that the bond yield might actually go up on that, and it sure has. And that's because the bond market's sort of agreeing with me, or let me be humble and say that I agree with the bond market, that the fact of the matter is it wasn't really necessary that the Fed did too much too soon.
Ed, given that's your view, how do you think you play it from here? If you don't think we kind of warrant more Fed cuts, we've obviously got the US election where both candidates are likely to expand the fiscal deficit. You know, do you think this results in an aggressive kind of bear steepening? Is it the long end you play, or is it that there is still juice in the front end in terms of pricing out those Fed cuts that are still aggressively priced?
Yeah. Well, look, I think there's a lot of uncertainty as we head towards the elections. I mean, we got a couple of major uncertainties that have something to do with politics. There's geopolitics. We know that the Israelis are going to attack Iran. We just don't know where or what or when. We also know that an election is about to occur in the United States. And even if we knew whether it was going to be Trump or Harris, we don't know how Congress will shake out. I think the stock market has to be concerned if we get a sweep by the Democrats or a sweep by the Republicans. I think the stock market has to be concerned if it's a very, very close and bitterly contested election. So I think the stock market will do best if we basically vote for gridlock, that whoever's in the White House just doesn't have an open season to do whatever they want, that they'll have a very contentious issue with getting things through Congress, which is, by the way our system was designed. It was designed to have checks and balances.
Ed, I'm gonna push you and put you on the spot, but I know you're not a man who's afraid of predictions. But we're asking today on the Markets Live blog, when will 10-year yields reach 5%? So give us your best prediction of the timeline of when we can see 10-year yields rise that high. We're about 4.2% at the moment. When do you think 10-year yields can reach 5%?
Well, I won't raise my ante to match your ante, but I think we'll see 4.5% probably early next year. 5% again will depend a great deal on the election results. I think if we do get a sweep by the Democrats or the Republicans, it almost doesn't matter. Either way, we're going to have wider deficits, more debt accumulating, and possibly inflationary consequences. And suddenly the Fed will be backpedaling and not easing, and maybe even talking about raising rates. In that kind of situation, I guess we could get to 5% pretty quickly, because the bond market was for a while factoring in several rate cuts by the Fed, because the perception was that the economy was weak, the labor market was weak, and inflation was sort of an automatic pilot going to go down to 2%. Now, all those assumptions seem to have been blown out of the water. And as you mentioned, we have some Fed officials already kind of walking back the idea that there's going to be a 50 basis point cut at the November meeting, or even walking back the idea that we necessarily will have 2 25 basis point cuts, one in November and one in December. I think, as you mentioned, none and done is the most likely scenario, because the economy is strong, labor market's doing fine, and inflation is, in fact, moderating. But within the inflation numbers, there's some disconcertingly hot areas.
Ed, back in the 80s, you coined the term bond vigilantes. Do you see bond vigilantes coming back post-election? I mean, how do you see them perhaps putting pressure on the government to perhaps rein in the fiscal deficit?
Yeah, well, it's funny. Every time the bond yield goes up, I do get calls from reporters in the financial world asking if the bond vigilantes are back. And I think they're waking up. Let's put it that way. I mean, we went from the bond yield being 3.65% when the Fed lowered the Fed funds rate by 50 basis points. And surprise, surprise, instead of the bond yield continuing to go lower, especially with the Fed signaling that they wanted to keep cutting rates, the bond yield went the other way, signaling that the market thought that they just were misreading the economy. And so I think the Fed's going to have to respect that. So, yeah, they're back, but not to the point where they're going to push us into a recession. But that's something we do have to worry about.
But will it be reaching a point where they'll put a lot of pressure? I mean, take a look at what happened back in 2022 when those bond vigilantes in the UK actually played a part in pushing off Liz Truss. Might we see a Liz Truss moment in the US?
We very well could. As a matter of fact, you went back to 2022 in the UK. I would go back to 2023, not that far back in the US. And between August and October of last year, the bond yield zoomed from 4.25% to 5%. And the only reason it started coming down on November 1st, not the only reason, but one of the reasons was inflation did continue to come down. And just as importantly, the Treasury Secretary, Janet Yellen, she used to be a Fed chair, but Treasury Secretary Yellen basically told the bond vigilantes, if you don't like my bonds, I'll do it in bills. And so she did cut back on bonds and then she did more in bills. And, I think we had something like $2.2 trillion raised over the 12-month period then. And 1.9 trillion of that was in bills.
Ed, over the last 15, 16 years, kind of since the great financial crisis, we've seen an extended period of US exceptionalism. I kind of have this theory that if we do see the return of bond vigilantes in the US, kind of enforcing a little bit of little bit more fiscal conservatism, it might be the end of US exceptionalism. And I'm curious if you kind of buy into that theory, that might be the turning point, and if you don't, what do you think can end US exceptionalism? Like, do you think it can end without the return of bond vigilantes in the US?
Well, look, if the bond vigilantes really come back in force and push the bond yield, let's say, up to 5% and threaten to push a recession, there'll be a financial crisis that I think will wake up the politicians, and they could very well translate to a political crisis, or even the politicians get the message that enough is enough. They can't just keep willy-nilly cutting taxes and raising spending and not being able to agree on anything in terms of some fiscal discipline. It's a man and woman made problem, this deficit issue, and if the bond vigilantes scare them enough, they'll come up with a 10-year plan that I think the bond market will conclude maybe will do the trick. It will bring in some fiscal discipline, and if that's the case, then I think we'll be back to talking about U.S. exceptionalism, that we can in fact fix our problems and continue to move forward. So look, I've been doing this for a long time, and the deficit's been a doom and gloom story for a long time, and one of these days it really will matter. And we came pretty close last summer, and you might be very well right that there could be another instance here where it becomes a more severe issue. So I wouldn't rule that out as a potential problem in 2025.
Well, Ed, we had Goldman saying that the party's over for the S&P. Those days of big gains in the next decade pretty much done. Your thoughts on where the S&P is headed year end and maybe the next couple of years?
Yeah, I like the boys and girls at Goldman. Typically, I beat them to change my forecast, and then maybe they get my research. But I like them way more often than not agree on things. But man, how depressing could it be that we can only look forward to 3% miserable gains? I mean, what's the point? Might as well just put the money in money markets or 10-year treasuries and forget about the stock market. I think we'll get 6%. I'll raise the ante on that one. I think we could get 6% growth in the stock market, and that's simply because I think earnings are going to do fine. Look, I'm optimistic. I think we're going to have what I've been calling the roaring 2020s. And it's actually been working out pretty well so far. Stock market all-time record highs. It's been roaring very well. And a lot of my thesis is based on a productivity growth boom. And we're starting to see that. Productivity over the past 4 quarters is up 2.7%, which is a very healthy increase. And productivity is fairy dust. It makes everything better. It makes better growth, lower inflation, profit margins are up, wages rise faster than prices. And we're seeing a lot of that, but we could screw it up.
We certainly could. I'm not sure if I got your targets, Ed. End of the year, where do you see the S&P?
Well, it's been funny. I've been among the most bullish forecasters. I mean, I did start to talk about this being a bull market back in November of 2022, and we made a bottom on October 12th. But even I have hoof marks on my back here because this bull just keeps running over my back. So for example, last year I thought we'd get to 4,600 by the end of 2023, and we got to 4,600 by the middle of the year. So, but I kept it there, and it ended up around 4,800. So it wasn't a big miss, but clearly I wasn't bullish enough. And sure enough, same thing happened this year. At the beginning of the year, I said 5,400, and we got there several months ago, so I raised it to 5,800, and here we are above that, and I'm going to resist raising my number. I see a lot of my competitors raising the numbers to 6,000 and so that's kind of my counter instincts up a little bit. But more seriously, I think, valuation multiples aren't cheap, and I'd like to see earnings kind of catch up a little bit here. So I'm sticking with 5,800 by the end of the year. That's not to say we couldn't get to 6,000, 6,100 in the next few weeks, but I think it'll correct from that kind of level. But I think we're looking at 6,300 next year, and by the end of the decade, I think a conservative target is actually 8,000. So I think we got a decade where we have a bull market.
Ed, what is the thing that most concerns you about being wrong and changing your view in that? I say that in context that I was slower than you to get on the idea of this US bull market enthusiastically. You got on in late 2022. I was late last year. But I've been very bullish this year. But I'm getting to that stage where, as you say, valuations are stretched. There's been the tailwind of productivity. There's also been the fiscal tailwind. And I guess the issue that concerns me is that the bond vigilantes enforce a little bit of fiscal conservatism. So we lose the fiscal tailwind before the AI transforms productivity even further again. And at these valuations, that might become a little bit of headwind, especially if those bond vigilantes are getting higher yields, constricting the consumer, constricting a little bit of lending. So that's my kind of worry for turning bearish in this market. And the catalyst might be the election. What is it that might suddenly get you sending out a report going, you know what, I was wrong. The bull market for the 2020s is at least temporarily over. I am at least temporarily turning bearish. What will be that trigger?
Yeah, I think you laid out a very plausible scenario, and timing certainly is everything in this business. And depending how things kind of fall into place, it could be a different scenario, maybe more bullish or more bearish. But I'm thinking that to get an outright bear market, you need a recession, or you need another one of these Godot recessions that everybody fears but doesn't show up. And that's kind of the camp we've been in. We've been in the soft landing and now no landing camp. But you're right. It could be a scenario where the bond yield goes up to 5% on a fiscal crisis situation, and that raises fears of a recession, and we'll get at least a correction out of that. And maybe a quick bear market. But I think the economy has already demonstrated it's remarkably resilient. It's not that interest rate sensitive after all. And I think it's what we've learned, maybe for the first time, is that not to just look at the charts on how recessions play out with the variables, but to look at the history of how things played out. And historically, what happened is tight monetary policy led to a financial crisis that caused a credit crunch that caused a recession. This time around, we did have a financial crisis last year in the banking sector. The Fed played whack-a-mole with it and immediately came out of the liquidity facility. And so they didn't have to lower interest rates. We didn't have a recession. And here we are with an economy growing at 3.4%, according to the Atlanta Fed's tracking model. So I wouldn't bet against the economy. And by the way, I wouldn't bet against the U.S. consumer. A lot of my friends are retiring baby boomers, and they've accumulated $75 trillion in net worth. And guess what? They're spending it as they're retiring.
So, Ad, how do you play this market? We know that you said before that you see a broadening of the rally beyond MEG 7. Where would you be putting your money?
Well, the MEG 7, I think, will continue to work. These are really great companies, but I think the market does broaden out to the S&P 493. So all the other stocks that are on the S&P 500, not that they've completely, done nothing. It's been actually a pretty broad bull market. When you look at it from where it started to where we are now, there's a lot of, just about everything's up at least 20% in the S&P 500 anyways. I wouldn't I wouldn't go into the Russell 2000 or the S&P 600, the small caps, because I think the market demonstrated that you need a scenario where interest rates are falling. And I think that that scenario is being taken away from those kind of stocks. So yeah, I would broaden it out into the S&P 493. And the sectors we've liked and we still like is technology, including communication services. And maybe you go, broaden out within those sectors. Financials look fine, look great, actually. The banks reported great earnings. Industrials look fine to us. And then the one clunker we've had is energy. We've kind of viewed that as a shock absorber for geopolitical risk. And oh, by the way, along the way, gold looks fine and silver looks fine, as not as an inflation hedge so much as seems like it's a hedge against the U.S. imposing sanctions against the countries that we're not happy with. So we did that with Russia, and now I think the Chinese are buying a lot of gold.
Speaking of China, Ad, let's take you to China. I mean, investors seem to be pretty divided on the stimulus that we've seen so far, whether that's enough to turn around the economy. But I think there's consensus that perhaps you've drawn the line, it's going to be well supported from here. Your thoughts on whether China has done enough to reverse that sentiment? We know the hedge funds are not quite buying into the story yet. Yeah,
I'm not buying the story because I think they're kind of using this same old tricks to try to get their economy growing. And in this case, they're trying to make credit cheaper. They're trying to encourage people to borrow money. They'd like to support the real estate market. But, once a real estate bubble bursts, as we saw in Japan and the United States, it could take a long time to get that sector of the marketplace to start improving. And so I don't really see much hope for the real estate sector. Maybe they'll cushion the blow from that sector. But what they really need, if I may be so bold as to give them advice, is they need helicopter money. I mean, that worked like a charm during the pandemic here in the United States, when we sent 3 rounds of checks to Americans and they went out and spent it. What they really need is clearly they need to stimulate domestic consumer spending. And they got so many, headwinds when it comes to that. Most importantly, the fact that the one-child policy has come back to haunt them, and they've got a rapidly aging population. So I'm not optimistic on China, and I don't like the fact that you can't really tell what the rules are, because the government can change them rather quickly. And we've seen that capital flight has been significant. Direct investments is down a lot, and portfolio investment is down a lot. So I think there are better places to invest than China.
Ed, can I clarify that you kind of see that the China domestic story and the China market story as one and the same there? I get kind of your argument there was much more about the economy, and real estate as a percentage of assets is now a much lower weighting, obviously, because it's lost so much. So you can be bullish on stocks, and you're not necessarily bullish on the real estate sector. And I feel that there's a potential at some times for markets to disconnect from the economic play in China. Right. The economy is never going to return to the mid-2000s. How do you think about that? Do you think there's a window for the government to stimulate the market, even though the economy won't turn around long term?
Yeah, I mean, it's been a great market for traders. I mean, you've had opportunities to make a lot of money in a short period of time, and then the fundamentals, then investors and even speculators look at the fundamentals and they're disappointed, and the market goes back down. So I don't know that anything has changed in terms of the underlying way that the market is going to trade. I mean, it would have been great to be in the market a few weeks ago and then see this thing go up 25%, and then it kind of went back down 10%. I mean, it's not really investing. It's trading, and I'm not particularly good at that. I prefer being a long-term investor.
Ed, we've seen a rotation from India to China. From what you've said so far, you do not expect that rotation to continue. I mean, what are your thoughts on where India's headed? We've seen extended valuations. Are they still looking attractive? Can earnings continue to support the rally that we've seen?
Well, I think India probably is an overcrowded trade. I mean, the valuation multiples have had a heck of a run. The earnings are doing pretty well, and the profit margins are improving. And I think you're right. There probably was there for a few days anyways, a move out of India and a move into China. But again, that was more moves for traders and for long-term investors. I've been recommending overweighting the United States since 2010, and I may overstay my welcome there, but that's still my position. I think you want to overweight the U.S., and I think there are opportunities in emerging economies, but a lot of them really need to see commodity prices go up. They need to see U.S. interest rates go down. Yes.
I'm afraid we have to leave it there. Ed, thank you so much for your time. Ed Yardeni, President at Yardeni Research, and Mark Cudmore, AmLife Executive Director. Thank you so much for your insights. Plenty more ahead. Keep it here with us. This is Bloomberg. Welcome back. You're watching Inside with me, Haslinda Amin. Taking a look where markets are right now. Asian stocks under pressure, down for a second day, tracking the losses overnight in the U.S., of course, coinciding with that sell-off in the bond market. We had 10-year yields jumping 11 basis points in the course of about a month. Those yields have surged between 40 to 50 basis points. Taking a look where we are in terms of the MSCI Asia Pac Index, currently extending losses down about 0.9%. That Hang Seng, though, bucking the trend, up by 0.4%. In terms of the Nikkei 225, it is under pressure along with the Kospi index, all that contributing to the pressure that we're seeing in terms of Asian markets today. Taking a look at where we are in terms of Asian FX, of course, it is about the dollar. Taking a look where we are in terms of the Japanese yen, 150.96. It has already breached that 150 psychological level. Remember that it is at this level that traders begin begin to wonder, awaiting the possibility of intervention by Japan. So far, nothing on that front in terms of the Chinese currency. 1351 is the level we're looking at. It is pretty flat right now. The PBOC continues to support the currency, not wanting to see too much movement in the Chinese yuan. In terms of the Korean won, it is currently at 1380. It is currently just a tad lower versus the USD, down about 0.1%. Now, let's take you to India. India says it has ended a 4-year border stalemate with China, marking a significant step toward easing tensions. The move also paves the way for a possible meeting between Prime Minister Modi and President Xi at the BRICS summit starting today. For more, let's bring in our government reporter, Sudhi Ranjan Sen in New Delhi. Sudhi, this is a very significant development.
Yes, it's a very, very significant development considering the fact that India-China relationship had kind of plummeted in the last 4 years, and everything was hinged and pegged to the border dispute. We've seen the Foreign Minister Subramaniam Jaishankar repeatedly saying that unless and until the border issue is sorted, there is no way that relationship can between the two countries can progress normally. And India had brought in, had started discouraging Chinese investments, Chinese companies, pull back on visas to Chinese professionals. Basically the border dispute had spilled over to the economic relationship, although trade between the two countries continued, but it was clearly having an effect and impact with the two in the economic relationship of the two countries. Now, whether this border dispute being sorted, resolved to a certain extent, means that India and China's economic relationship goes back to what it was pre-2020, that is still not clear. That needs to be watched very, very carefully in the coming days.
Sudhi, the main question is how much can really be achieved at that meeting, potential meeting between Xi Jinping and Narendra Modi?
Well, a lot can be achieved because what we saw and what we've seen, in the past, India-China relationship is largely top-driven, and once the two leaders or once the political leadership is on the same page, then a lot of things start flowing, and it was specifically because of this reason the meeting, because the political leadership were not in the same page, so to say, you had it spilling over to the economic relationship as well. So if in terms of what can be achieved, yes, a lot can be achieved, but then it will not. I mean, from what we're getting to hear from in New Delhi, that it's one should not expect things to go back to normal or turn around completely immediately. It will take a lot of time because what India says is that there is a huge trust deficit now, and that needs to be capped. On the other hand, what we hear China saying that let the border issue stay where it is while you cooperate and coordinate in other areas. So yes, I mean, a lot can be achieved, but no instant turnarounds are unlikely at this moment.
Sudhi, thank you so much for that. Bloomberg government reporter Sudhi Ranjan Sen in New Delhi for us. Now, both India and China have ties with the U.S. that contain elements of cooperation, competition, and sometimes conflict. The clean energy transition and critical minerals are particular areas of potential friction. Let's get perspective, insights from Geoffrey Pyatt, U.S. State Department Assistant Secretary for the Bureau of Energy Resources. Secretary, good to have you with us. We just heard from a colleague about how Modi and Xi Jinping will be meeting at the BRICS summit in Russia. Your thoughts on warming relations between the two sides, given, I guess, the perspective that the U.S. uses India as a counter to China's growing influence?
So, Haslinda, I'll offer a slightly different perspective from my standpoint as somebody who's worked on the U.S.-India relationship literally for decades. And I don't think we're trying to use India against any other country. What we're trying to do is build our bilateral relationship The issues I'm responsible for, energy inputs, are a central aspect of that overall bilateral relationship, a big part of our overall trade relationship. And I'm particularly focused right now on the work that the Biden administration has been leading with Prime Minister Modi's government, focused on supply chains and how we diversify the supply chains that we need to drive forward the energy transition, but to do so in a way that doesn't increase our vulnerability to any single country, China in particular.
It does seem like India and China are trying to forge a relationship, a partnership perhaps in terms of clean energy. How do you view that? Do you think that will be detrimental to relations between India and the U.S.?
I don't think it will be, for two reasons. First of all, the choices that India and China make about their future energy pathway is going to have a central impact on whether or not we're successful in our overall climate goals, keeping 1.5 degrees of temperature change within reach. We all need to move as fast as we can to deploy and innovate in the clean energy space. What the United States is saying, and I think it's exactly the same thing that Prime Minister Modi is saying, is we want to do so in a way that is also secure, reliable, affordable, builds resilience in our supply chains. We see a tremendous opportunity with India, especially because of the rise of global Indian companies like Tata, Reliance, Adani, Birla, that share the Biden administration's focus on decarbonization, especially for big industry, and also share an interest in developing resilience in those supply chains and diversity of sources. Diversity has been the core principle of America's approach to energy security, really since we started to focus systematically on these issues during the oil crisis of the 1970s. And it's just as true in the clean energy era as it has been in the historic 50-year period of fossil energy diversification.
As you look to build that relationship with India, does it bother the U.S. that India continues to have that relationship with Russia? It is now the biggest buyer of Russian oil, overtaking China. I mean, how do you square that, Secretary?
So this is an issue that I've discussed a lot with my Indian counterparts. I've had the opportunity on multiple occasions to continue this conversation, including with Minister of Oil and Gas Hardeep Puri, a good friend of many decades who was in the United States, in Houston just a few weeks ago. Our goal with Russia is very simple. It's to drive down the revenues which Russia enjoys from its oil and gas resources, which go to pay for a brutal and unprovoked invasion against Ukraine. Our price cap policy was designed to avoid disruptions of global crude oil supply, which would cause a spike in prices, which would mean that Russia would get even more revenue for its oil exports. So we're looking to ensure stability in global supplies while at the same time driving down Russia's revenues. India has been an excellent partner in the implementation of that policy, specifically through the work that India has done in order to encourage its companies, its purchasers of Russian crude oil, to do so within the framework of the price cap rules. As Minister Puri says, and he said this directly to me, the tougher you Americans are on the enforcement of the price cap, working with your G7 colleagues, the better the price I will get for the crude oil that I need to buy to drive the Indian economy. So our goals are convergent. I would also note in this regard the very clear messages that Minister Puri and the Indian government have delivered on the question of Russian gas exports, which is the other side of the equation, and a lot of the work that my team has led on the enforcement of our sanctions against future Russian energy projects like Arctic LNG 2, where Minister Puri and the Indian government have been clear that they are not going to engage in that market either.
Secretary, we have India buying Russian oil, we have China buying sanctioned Russian LNG. Are you considering retaliatory measures perhaps on China on the back of that?
So let me talk about the LNG sanctions in particular, because I think it's important to understand what's happening here. Our goal on our LNG sanctions is to ensure that Novatek in particular is not able to take the gas that Gazprom used to send to Europe through pipeline exports and redestine that gas to global markets. We've been particularly focused on the Kremlin's flagship project, which is Arctic LNG 2. You've seen a very aggressive program of Western sanctions against Arctic LNG 2, against ships that load from Arctic LNG 2, against the technology providers that have provided equipment to facilitate that project. So far, and I haven't checked this morning's news, but as of yesterday, not one cargo loaded by Arctic LNG 2 has found an international market. So our policy is working. It's working because we're coordinating very, very closely with our partners across the G7 and in ports that are potential destinations for those cargoes. I can't speculate on future sanctions actions, but what I can tell you is that we're paying very, very close attention to where sanctioned Russian cargoes are heading. And you can be assured that the Biden administration is going to continue to tighten the screws against Russia's LNG exports, because that is a key source of the revenues that Putin uses to carry forward his war.
You talked about how those sanctions have worked. Are you considering restrictions on Russia's LNG plants, for instance, in the Arctic, in the Far East? Is that being considered?
So nothing is off the table at this point, and especially on questions of gas, we have greater freedom of maneuver. I talked earlier about the importance, the priority that the Biden administration has placed on not shocking global markets, not driving up crude oil prices. But gas is different because the United States today is the world's largest LNG exporter. We have huge capacity domestically. Liquefaction capacity in the U.S. is going to double by 2030 based on projects that are already FID'd, already underway. And that means that we have freedom of maneuver to really tighten down our sanctions on Russia. And I think as long as Putin continues with this unprovoked invasion, as long as he continues not to take opportunities to de-escalate, you can be confident that the Biden administration is going to continue to work with our allies and partners to target this sector, which is so central to the Kremlin's ability to finance its aggression.
You talked about how nothing is off the table, that those restrictions on Russian LNG plants overseas in the Arctic and the Far East may be considered. I mean, what are some of those considerations? When might you decide, on that decision?
So one big consideration is how we work with our allies and partners around the world. I'm here in Singapore at Singapore Energy Week today. We've been talking with our partners in Singapore about the important role that American LNG plays in Singapore's energy security. That's doubly true in the case of allies like Japan, like Korea. We're not going to do anything that places the energy security of our close allies here in Asia in jeopardy, but we are going to do as much as we can within that limitation in order to restrict the revenues that the Kremlin gets from its gas exports. And I would emphasize, especially in Europe, and I was just in Europe 2 weeks ago working with our colleagues at the Commission, because gas for decades was one of the principal leverage points that the Kremlin used against our allies in Europe. Today that leverage has been broken. Europe has almost completely decoupled itself from Russian gas supply. It's done so on the back of diversification, greater efficiency, an accelerated energy transition, and a very strong LNG import relationship with the United States.
Secretary, it's not just about Russia, it's also about China. You've put restrictions on China's solar sector. How much dent have you made on China's dominance in this space?
So thank you for raising this, and it's a really important question because it reflects what we're trying to do in our relationship with China. China's a very important country on the global energy transition conversation. We're going to see a lot of that in a couple of weeks when we're all in Baku for COP29. But we also have a very strong desire in the United States, here in Asia, in Europe, to make progress in diversifying the supply chains for the key inputs that we need to power the energy transition. Solar cells, battery cells, wind turbines, critical minerals. Because of several decades of inattention, we allowed ourselves to get into a position where China enjoys a monopoly or near monopoly in too many of those supply chains. So we need to diversify those supply chains. That's what the Biden administration is doing at home with the Inflation Reduction Act. $36 billion a year over 10 years. It's stimulated already nearly $500 billion in new investment in clean tech manufacturing and clean energy production. But it's going to take time. The fundamental principle of the Biden administration on these issues is that we cannot be successful alone. We can only achieve success in our energy transition and to the extent that we build broad international coalitions, to the extent we help to address the concerns of the developing world, where in much of the developing world the issue is how to get any power access at all. But we also want to do so in a way that doesn't deepen our dependence on a single source of supply.
Secretary, of course, the world is paying close attention to the upcoming election in the U.S. How might a Trump administration impact the U.S. energy security? Might he also be dialing back on efforts to achieve, a more productive, clean energy space in the U.S.?
So I'm a career diplomat. I'm not going to speculate on the outcome of our elections or what a future administration might do. But the one thing that's clear to me, and I've traveled around the United States a lot in this role, I see hundreds of thousands of jobs being created in Republican states and in Democratic states, driven by the clean energy transition, driven by the opportunities that are created through our Inflation Reduction Act and our bipartisan infrastructure law in the United States, and frankly, driven by the choices that our big companies are making. I'm here in Singapore with senior officials from Chevron and Exxon. They've all been talking about their corporate commitment to new energies, to clean hydrogen, to carbon sequestration, to better monitoring and abatement of fugitive gases like methane that have such a damaging impact on our climate. Those are structural changes in how the U.S. economy is working. And I am confident that regardless of what our election outcome is, those changes are going to continue because they're being driven by the market, driven by consumer choices, and driven by the determination of the United States to play a leading role working with our partners around the world to leverage the opportunities that this energy transition is going to create.
Secretary, we thank you so much for your insights today. U.S. State Department Assistant Secretary Geoffrey Pyatt there. Well, still to come, Hyundai India is about to make its trading debut. We look at how it could drive other billion-dollar-plus deals coming to the market. Keep it here with us. This is Bloomberg. Welcome back. We're taking you to Mumbai, where we have a huge IPO. Avril Hong is on top of developments. Avril, it has to do with Hyundai Motor India.
Yeah, this is a record in terms of the proceeds that have been raised out of India for this particular company. And as you say, there's a lot of excitement surrounding this. So we are watching very closely how investors are going to be receiving this on the first day of trading. Of course, what was really interesting out of the share sale last week was the way in which retail investors were pretty lukewarm to the IPO. I think they only scooped out about half what was allotted to them. And this is, after all, a market that is the busiest venue for IPOs in the world this year. So it was quite something to see the way in which retail investors received it. I think some have put out some theories out there as to why there was a valuation risk. Things were on the upper end. So that didn't leave very much on the table for investors in terms of future gains. And then you think about how the funds accrued are going to be going straight to the parent company, not to Hyundai Motor India itself. So that was also a bit of a cause for concern. But I think chief among these concerns was also the timing. You think about how we've seen the India auto stock rally that's kind of cooled off a little. And then India, broader markets, they've underperformed given how investors are weighing out the China stimulus prospect. So these are the kind of factors that we're going to be watching very closely when trading begins, whether they figure into the equation for investors.
Retail investors notwithstanding, it was oversubscribed, more than 2 times oversubscribed, and it has to do with institutional interest. Talk to us about that, and also So what's the outlook now?
Absolutely. I mean, it was really interesting to see the way retail investors in the first few days of the share sale actually, reacted versus on the last day when the institutional investors kind of scooped in and saved the day, sent things, I think, oversubscribed about 2 times, as you mentioned. I think this speaks to their belief in India's growth story. I mean, you think about rapid economic expansion, you think about the growth of the middle class, but to some investors, this also speaks to how some are looking for companies that are diversifying their manufacturing bases away from China. Have a listen.
India becomes potentially a very important alternative manufacturing base to China. Hey, let's look at what Hyundai's done there. Can we also duplicate and set up global manufacturing bases in India for exports worldwide? That's the upside that investors would be looking at who put their money into the Hyundai's operation there.
So put their money there, as you heard from our guests earlier on in the program. And you can really see how, for some, this is more of a longer-term value play. So not really if you're an investor looking for quick gains.
The thing is, this might just set the tone for more billion-dollar or plus deals or IPOs.
I mean, this is something that I think is a key litmus test to see the extent in which demand is trading or treading and how much further we can see this IPO boom. I mean, it's not just about India. This week, we are looking at this bumper number and amount of listings in the Asia region. I think the most in about 2 years. So what investors want to see is how all this is received and to see whether animal spirits are returning.
That's right. Foreign funds may be pulling the money out, but IPOs in India, well, that's drawing money in. Avril Hong, thank you so much for that. And subscribers can also turn to the Bloomberg for more on this. Go to TLive Go to get your commentary, your analysis from our expert editors. Well, coming up after our show today, ASML President and CEO will be speaking at the Bloomberg Tech event in London. Catch live coverage here on Bloomberg TV or on Bloomberg.com. And before we go, here's a look at the guests joining us tomorrow. The CEO of the Philippines' largest conglomerate, Ayala, will be with us exclusively. We'll ask Cesar Consing about the investment landscape and the impact of monetary easing on his businesses, plus insights on the biggest market risks and opportunities with UBS Global Wealth Management's Min Lantan. Don't miss that. That is Insight for now. Horizons Middle East and Africa is next. This is Bloomberg.